Hello, my dear students. We'll be continuing from where we left in the first class. We begin with accounts of a partnership firm. You will find that note written on page number 1.22, and you have list of 7 subtopics under it: partners, capital account, interest on capital and current account, and so on and so forth, ending with past adjustments. So what I'll give you an overall the idea is still point number 5 as of now. 6 and 7 will be dealing later on. First, we begin with partners' capital accounts. Now, you've already got an idea as to what capital accounts are. Now, under the partnership concept, we maintain partners' capital accounts under two methods. One is fixed capital accounts method, the other one is fluctuating capital accounts method. Now, where the sum says that it is fixed capital account method, it means that you cannot pass any adjustment or make any changes in the capital account balance. So capital account will not have any entry at all. So there what we do is corresponding to your PL appropriation account, where you went on entering items in the debit side like to salary, to partners commission, and so on and so forth, the corresponding effect will not be falling on partners capital account, rather it will be coming to partners current account. You can see the next page, the format is given there. They've given a gist in your textbook itself, like they've given two sets of ledger accounts there: partners capital accounts and partners current account. In partners capital account, you can see two balance brought down and two balance carried down. The balances come as it is, whereas all the other adjustments like interest on capital, interest on current account, commission, partner salary, all that will be featuring in the credit side of the current account, and on the other hand, the corresponding other items will be featuring in the debit side of the current account, right? So we show it like that. When you turn to page number 1.24, there you will see they've given the second method, fluctuating capital accounts method. Now, under the fixed capital account, because the name suggested fixed, so we took the help of current account, right, from where all the adjustments were passed. But if nothing is specified, then by default we assume that the sum is giving us the liberty to use capital account as the place to show the corresponding effect of all the partners ka appropriation transactions. Okay, so over here there's no need to open a current account. You will straight away open a partners capital account, like we bring forward the partners capital account balance. So you will write that. And in partners capital account, you write the balances, put all the corresponding entries like by interest on capital, by commission, by partner salary, then on the debit side two drawings, two interest on drawings, and so on and so forth, and you will close the balances. So this was the first concept. And then you have the related illustrations. You can go through that, and there we land to this one: interest on capital and current accounts. Now, of course, if a partner is contributing capital or he is maintaining a current account balance, then the firm is supposed to pay interest on capital, isn't it? What you will do is carefully before illustration 19, there's a rectangular box which suggests or which gives you the details of justification for allowing interest on capital, and the reasons are there. Just give it an important reading. Then come to illustration 19 on page number 1.35. Please mark that illustration. There are 7 cases there. You will go through those cases. We have already discussed previous examples, like in my previous lecture only. I have given you examples based on percentage wise calculation of capital, interest, and so on and so forth. So this is just a summation of that case wise. So both the effect in journal and ledger, they have shown it to you. You will go in details through all those illustrations, and then we come to page number 1.42. Here I will be dealing with illustration 21, where we are trying to calculate the opening capital. Now, this is not the first time that in accounts we are calculating opening capital, isn't it? We've done that under the single entry concept also. What happened there? You prepared a statement where you began with capital at the end, right? Remember, everybody is recapitulating what we've already learned under the single entry system. When you were calculating opening capital, we prepared a statement for calculation, and the first line was capital at the end of the year. Then we added back drawings, interest on drawings if required, then less fresh capital, less share of profit, and what we landed up finally was opening capital. I'm sure by this time you must have recollected. All of you must have recollected. So what you need to do is, under illustration 21, you will find partners are there. 7 lakhs and 6 lakh contribution of capital is given. Then certain adjustments are given, like drawing 75,000, 50,000, B introduced capital of 1 lakh during the year, B or whatever the name of the partner is. I'm not taking the name of the partners because, as I told you in the previous lecture only, that the edition of the book may be different in each of your case and you might have different names, but the data remains to be same. Interest on drawings debited to capital accounts is 7,500 and 5,000, and then finally share of profit is 1 lakh. So, taking into account for both the partners, see, they've given you two options for the solution. One is statement format, the other one is ledger account. In ledger account, you go on doing the posting for further capital, then profit share, drawings made, interest on drawings. The balancing figure would be opening capital. Similarly, on the other hand, if you go for the statement format solution, you begin with closing capital, add drawings, add interest on drawings, less capital introduced, less share of profit, and you get the answer, right? Furthermore, the illustrations, you can go through them, they will clear your concept further. What I would highlight is, come to page number 1.47. You've got there the concept of interest on drawings. Now be very, very careful about it, because ISC will be giving you separate questions also on this particular concept. Now here you have two methods over there. You can calculate, you can come to page number 1.49. to calculate interest on drawings, you've got a product method and an average method. Now simple product method is like, they will give you the date of the drawings, the amount, the number of the months. You calculate the interest like you did in class 6, 7, 8 arithmetic sums, isn't it? You were given the amount, you were given the time period, the rate of interest is given, you calculate the interest. So like over here, solution part 1, you can go through that particular illustration given on page number 1.49, and you will find in a tabular method, under simple method, they've just calculated the total 10,750. It's coming to amount of total drawings is 1,70,000. So interest is coming to 2,750 on a simple basis. If you are doing product method, then similarly you prepare these columns, and with the amount and the number of months, you calculate the products. That's coming to 8,60,000. You multiply it with the percentage rate and divide it with the entire tenure of 12 months, and you get 10,750. So that was product method. And the next following page will show you the average period method. Now average period method is where we are going to learn about that what happens when a partner doesn't really withdraw money on a particular opening date of the year or in the closing. He goes on regularly withdrawing money all 12 months, or maybe quarterly, or maybe half yearly. And not only that, he's more specific about the thing, that whether he's making the drawing at the beginning of the month, middle of the month, or end of the month. See, now the calculation and the interim details, the council doesn't ask, or that is up to you whether you want to actually decipher the calculation. That's not required so much so as of now. But then what I would like to highlight is that based on these calculations, if you come to page number 1.54, you will find there's a rectangular box given on interest on drawings, and they've given you the rate percentages. Okay, and the referred illustration number is also there. There are 10 points given where you're told that if a partner withdraws on a monthly basis regularly, all 12 months, then at the beginning of the month he should be charged 6.5 months per annum. Middle of the month it should be 6 months, and end of the month it should be 5.5 months, right? You will carefully study this table. Like I told you, there are various slabs. You got to learn those slabs, especially points number 1 to 6, which deals with beginning, middle and end of the month, beginning, middle and end of the quarter. So you will first read this and then come back to illustration 30 on page number 1.50, where you will find the sum given to you that a partner withdraws for 10,000 per month, then interest is charged at the rate of 15% per annum, and they've given you various slabs, beginning of the month, middle of the month, end of the month, and accordingly the solution is given. So if you know the rate percentages, if you remember the time slab, then calculation is not so difficult, right? After you deal with interest on drawings, you will come to page number 1.54. Next, we are dealing in detail with partner's salary or commission. Now, when you deal with partner's salary or commission, what you're supposed to do is that this we've already dealt with. Partners will be getting salary on a per month basis or a per annum basis, and commission will be generally given to you as a percentage of sales or percentage of net profit or something like that. So you just give it a reading there, what I have already discussed in my previous lecture. They've given that in writing on page number 1.54, and you should come to illustration number 37. Page number 1.56. There you have Tej, Partho and Guinea, 3 partners, 2:1:1, and they've been given 1st October. Their balances are given for the current account. Capital account is 60,000, 40,000, 30,000. Then they've given the drawings 200, 400 and 1800, beginning of the month, end of the month, and during this period. I'm just reading out the sum, nothing to worry. I may be reading it fast, but I'm just reading out the sum. You've got the text in front of you, concentrate, and you'll be able to, pace up. Now, the deed provides, you can underline, if you have a pencil in your hand, you can underline, partners were allowed interest on capital at the rate of 5% per annum. Partners to be allowed or charged interest on current account. Now, allowed or charged interest on current account. Why hasn't the sum specified whether allowed or charged? Concept should be clear. When will the firm allow interest? When obviously the partner has a favorable balance of current account, right? Current account is a replica of capital account, so favorable balance of current account will be credit balance, right? So when a partner has credit balance in current account, the firm will allow interest. On the contrary, if a partner has debit balance of current account, then obviously the firm will charge interest, isn't it? Right. You have that smile on your face. You understood it well. Interest on drawings to be charged at the rate of 6% per annum. So they've already said. Now, how do we apply? Go back to those 3 lines given. Like say, Tej withdrew 200 at the beginning of each month. So 6% of total drawings amount into, at the beginning of the month, the slab was 6.5 by 12. So it will be rupees 200 at the beginning of each month. So what is the total drawings? 200 into 12, that's coming to 2400 into 6% into 6.5 by 12. Now, who withdrew during the month or at the end of each month? Partho, right? 400 at the end of each month. So when he withdraws 400 at the end of each month, how much it should come to be? It is coming to be 400 into 12. So that's 4800 into 6%. Now you will find all that calculation, what I'm dictating or what I'm actually discussing with you. It is all there in the working notes. You can go through that and all your doubts will be clear. So if you check the next page where the solution is, see, on the debit side, you should be giving partner salary. So that's given. Interest on capital, that's given. Interest on current account, that also given. Commission. And then credit side, you've got interest on current account and interest on drawings. Why do you have interest on current account for Tej or Partho in the credit side? Because of course, they have unfavorable current account balances. See, Tej and Partho, they have debit balances of current account. So that's unfavorable. That's the reason why, like interest on drawings, the firm will charge interest for them. And finally, when you get the balancing figure of 1,93,918, that's the profit to be transferred, and you divide it in the ratio of 2:1:1. Go through the sum. This is the first full-fledged PL appropriation account sum solved in front of your eyes. So please go through it well. The fifth one that I would be discussing last for today, that is transfer to reserve. Now this is nothing different, but that's the same thing that we did in final accounts for class 11. In final accounts, you transferred reserve money from profit and loss account. So in the PL account, in the debit side, you wrote to reserve. So over here, it is PL appropriation account. So in the PL appropriation account, you will be writing to reserve. Simple as that. Apart from that, in the PL appropriation account, whether you use partner's capital account or you use partner's current account, all other portions being same. So by the next time, till the next date, when we interact furthermore, before that, your work would be to be well versed with all these pages, the contents of this, as I have explained. Go through my lecture, go through the YouTube video link that I have sent you again and again. Make the concepts clear, and one more thing. That is illustration number 40 on page number 1.61. I'm discussing it, which is the last one for today. And after my discussion, you will go through the solution. Then you will go back to a practice exercise book, close the solution and try and solve the sum on your own. The sum is nothing or not so difficult at all, though it is an ISC sum. See, it is highlighted ISC 2009. There are three partners, Basu, Harish and Jadhav. Then they've given adjustments: interest on capital, interest on drawings. Harish and Jadhav, they've got salaries. Basu is supposed to get a 5% commission on net profit. Then they are saying that the remaining profits are to be divided as 40% Basu, 30% Harish, 20% Jadhav, 10% to reserve. So whatever the profit comes to be, you will have to allot 10% of that to the reserve, and the rest will be given to the partners according to the percentages given. Net profit for the year ended, they've given. Basu withdrew at the beginning of each month, Harish withdrew middle of the each month, and Jadhav withdrew money at the end of the each month. Now we already know, according to the interest slab, how to calculate interest on drawings. You see the solution. See, on the debit side, they've given salaries, commission, interest on capital to all the partners. Nothing said. I told you at the very beginning that if nothing is mentioned, then by default you will assume that capital account is fluctuating. So you can show all the adjustments through capital account only, not through current account, right? So you will be showing all the postings in the debit side. In the credit side, you will bring down that net profit of 50,000. You will, the firm will be collecting interest on drawings from all the three partners. See, total amount of drawings into rate percentage into 6.5 by 12, 6 by 12 and 5.5 by 12, because one has withdrawn the money at the beginning of the month, at the middle of the month, and at the end of each month, right? After that is done, you get a total net profit. Just one thing, write the net profit total amount in the amount column and the breakup values of 10,120, 7,590 and 5,060 in the inner imaginary column, like we've been doing so far. So I'm sure you will be able to complete your work till we interact next time again. Your work would be till transfer of reserve. Go through the entire bunch of sums that you have in your book already done, because next day we'll be dealing with some practical unsolved problems, right? Take care of yourselves and see you soon.